Hey, welcome to our weekly segment where we guide you on your journey to financial literacy.
We like to make these videos short and sweet in hopes that you learn a new economic term while keeping you updated on 3 financial events that happened in the past week.
Without further ado, let's get right into it. So on the surface, US stocks hit a new all-time high again last week, bringing the tally to more than 50 record closes so far this year. The S&P 500 has risen nearly 20% year to date, which ranks 5th in annual price gains over the last 20 years. However, under the surface, the S&P 500 index has delivered a steady rally with only 4% pullbacks this year, the underlying composition rotating between optimism and caution. Enthusiasm over the reported reopening saw market gains driven by cyclical areas, including value investments and small cap equities. That has shifted more recently, with defensive and growth investments leading, reflecting a more risk-off tone that has underpinned the more moderate gains of late. Interest rates remain historically low, ticking only slightly higher last week, despite growing expectations for the Fed to begin winding down its bond purchases. Yields have largely treaded water this summer, even as unemployment has fallen, GDP has risen above pre-pandemic levels, and inflation has surged amid rising wages and ongoing supply shortages. Looking beyond nominal Treasury yields, high-yield bond spreads remain notably narrow, reflecting ongoing confidence in the fixed income markets around the outlook for the credit cycle. High-yield spreads are not signaling rising concerns over the economic cycle or implementing credit stress among corporations. Consumer spending has softened under the weight of the Delta variant and renewed restrictions. A swath of economic readings last week revealed some emerging spending fatigue. The July personal spending report showed a modest 0.3% increase in spending versus the prior month, notably weaker than June's pace and a de-acceleration from the average of 1.6% over the last 6 months. This aligns with last month's weaker retail sales report, raising worries over the health and durability of the economic recovery. Many surmise that this, along with the talk of reduced Fed stimulus, is playing a key role in the rotation toward a more defensive posture in equity performances, as well as the subdued interest rate environment chronicled above. The recent decline in the Consumer Confidence Index captures the shift in conditions being driven by the Delta variant and rising inflation. Prior experiences show that this is likely to be accompanied by a deceleration in personal consumption, which compromises the lion's share of the U.S. economy. This may drive a slightly lower than anticipated GDP reading in the third quarter, but it should not be lost that the economy is running at a well above trend pace and is likely to remain there throughout the year. Anyways, that pretty much wraps up the financial news for this week. Now I'm going to hand it off to Om as usual to discuss the financial term.
For this week's financial term, let's talk about amortization. There are 2 types of amortization in particular. One relates to the process of paying off debt, and the other is in accounting, where amortization is a way to lower the value of an asset on the balance sheet over time. Amortization holds especially true for intangible assets. Essentially, we are trying to reduce the price of an asset concerning its life as an asset. Or maybe in other words, we're trying to find that opportunity cost over time, right? Because an asset becomes less efficient. And to find that opportunity cost, we need to assign that a value in the balance sheet for a more accurate representation. When businesses amortize expenses over time, they help tie the cost of using an asset to the revenue that it generates in the same accounting period. Furthermore, this is essential to tax deductions, as amortizations do count against a balance sheet. They subtract value. So that does mean that the company inevitably does get taxed less. Now, we're talking about a common misconception between amortization and depreciation. Amortization and depreciation are both similar concepts in that they both involve reducing the price of an asset in an attempt to capture the cost of holding an asset over time. The main difference between them is that amortization refers to intangible assets, whereas depreciation refers to tangible assets. Examples of intangible assets would include trademarks and patents, while tangible assets include equipment, building, vehicles, and other capital assets subject to physical wear and tear. Anyway, that's all for today, guys. Thanks for tuning in, and I hope to see you next time. If you enjoyed the video, please drop a like and subscribe if you haven't already, as it really does help the channel grow. Thanks a lot, guys.